In February, the Supreme Court told this administration its tariffs were illegal. By then, importers had already paid about $175 billion. That money is now coming back, and this quarter, for the first time, you can see exactly where it lands, because it is showing up in filings with the Securities and Exchange Commission. It is not landing with the shopper who paid the higher price. It is landing in the cost of sales line. Good morning. This is the Asymmetric Daily Brief for Tuesday, August 4th. Here is everything that matters today. Here is the board. The S&P 500 printed a fresh all-time intraday high near 7,665, up about 1.5%, taking out the record it set on June 2nd. The Dow climbed 916 points, 1.7%, to its own record. The Nasdaq popped 2%. This was a broad, genuinely strong day, and it was driven by earnings rather than by the Federal Reserve. Bitcoin is the outlier and the most interesting line on this screen. It sits around $63,000, which puts it just below its 200-week moving average of roughly 63,770. That is a level Bitcoin has traded above about 92% of the time in its history. Gold is firm, just above $4,000 an ounce. The 10-year Treasury yield is in the mid-4% range and moved lower on the day. I will be honest with you about that number. My sources disagree on the exact level today, so I am giving you the direction and the range rather than a false decimal. And the Federal Reserve is on hold at 3.5 to 3.75% for a fifth straight meeting, with 3 officials dissenting in favor of a hike. That is the most same-direction dissents since 2016. So let us start where the day started, with the story everybody was sharing. In February, the Supreme Court held 6-3 that the International Emergency Economic Powers Act does not give a president the power to impose tariffs. Roughly $175 billion had already been collected at the border, and almost everyone read that as money coming home to the people who paid it. That reading is wrong, and the mechanism is not subtle. The Court of International Trade directed that refunds go to the importer of record. That is the company whose name is on the customs form, not the shopper who absorbed the tariff in the shelf price. And the process is opt-in. Customs and Border Protection built a module called CAPE, launched on April 20th, and it does not pay anybody automatically. A company has to come forward and file. And here is what makes today different from every other day this story has been argued. We do not have to speculate anymore because the filings are out. Carter's, the children's clothing company, disclosed that it recognized about $128 million as a reduction of cost of goods sold, plus $4 million in interest income. Stanley Black and Decker recognized a pre-tax gain of $118 million in cost of sales. Tariffs received about $29 million. Hubbell received about $30 million. These are not estimates from an analyst. These are numbers the companies filed with the Securities and Exchange Commission. And the language in Carter's filing is the part I want you to hold on to, because it is doing all the work. The recovery is booked as a reduction of cost of goods sold, quote, for amounts related to goods already sold. The customer paid the tariff-inflated price. The company keeps the refund on it. We are doing a full deep dive on this one today, and I will point you to it at the end. Second read of the day, and this one is about a disagreement between two markets. Today's earnings were spectacular. Palantir rose about 26% after a quarter its chief executive called otherworldly. That is its 12th consecutive quarter of accelerating growth. Caterpillar gained 12% and cleared $20 billion of quarterly revenue for the first time in the company's history, as a direct beneficiary of the artificial intelligence build-out. So the equity market's conclusion was straightforward. The artificial intelligence trade is not a bubble, it is a business. And on the demand question, that conclusion is correct. The trouble is that demand was never the contested part. Because one market over, the credit desks are charging more to insure the same companies. Nvidia's 5-year credit default swaps hit a record 82 basis points on July 27th, the largest single-session move since those contracts began actively trading. Now, context that the loudest version of this story leaves out. 82 basis points is still well below the roughly 200 basis point level that signals real investment-grade stress. Nvidia is not in trouble, but Oracle is trading above 215 basis points, up from around 145 at the end of last year. and CoreWeave swaps are pricing something close to a 50% probability of default within 5 years. The mechanism underneath is circular financing. Nvidia takes equity stakes in or guarantees debt for customers who then use that capital to buy Nvidia chips. Both the International Monetary Fund and the Bank for International Settlements have flagged that pattern as a systemic risk. Equity is buying the demand story. Credit is pricing who financed it. Both can be right, and they resolve on different timetables. Third read, and it comes from the most shared technology take in markets today, from a very public figure who argued that source code is on the verge of becoming like assembly language, and that the next step is getting rid of source code entirely. Now that is a forward-looking prediction, not a fact, and we are going to treat it as one. But it points at a real question, which is what artificial intelligence is actually doing to software employment. And the honest answer is more specific and more uncomfortable than either side of that argument allows. United States software development job postings are up about 15% since February of last year, while postings across the whole economy fell about 7%. So the category is growing, not shrinking. That is from Indeed's hiring lab, and it is the most reliable number in this segment. But look at the composition. Roughly 71% of that growth is in senior roles. And according to industry trackers, which I would treat as directional rather than precise, entry-level roles for people aged 22 to 25 are down about 20% since 2024. Junior hiring is down around 35% from 2023, and postings for artificial intelligence engineers are up roughly 300%. So this is not deletion. It is a ladder with the bottom rung sawn off. And that is the harder problem of the two. Because you cannot hire a senior engineer out of a world that stopped producing juniors. Now follow the money, and the biggest structural event of the week was not American. Japan's Ministry of Finance confirmed a coordinated yen buying operation with the United States Treasury. That is the first joint intervention between these two governments since 1998, and there is a mechanical detail in it that tells you how carefully it was staged. The New York Federal Reserve sold euros, not dollars, to buy those yen. That let the Treasury Secretary tell markets, accurately, the Treasury sales did not fund the operation. The yen had reached about 164 to the dollar, close to a 4-decade low, and strengthened to roughly 157.5 by Friday. By Tuesday, it was drifting back toward 158, and Japan's 10-year auction drew its weakest demand since May of last year. An intervention that works for one session and fades by the next is not a policy, it is a distress signal. The thing to watch is Japanese auction demand, not the spot exchange rate. On sentiment, and this is drawn from broad market and social sentiment monitoring rather than any single source, the split right now is unusually clean. Equity positioning is euphoric and getting more so. Records on the Dow and the S&P, volatility complacent in the mid-16s, and a genuine breadth improvement today rather than another narrow melt-up. Against that, the commentary from people who watch credit and funding is close to uniformly anxious. And it has been for about 2 weeks. Those two groups are not usually this far apart. When they are, the historical pattern is that credit is early rather than wrong, but early can last quarters. Meanwhile, the labor data keeps softening quietly. Job openings came in at 7.359 million against expectations near 7.4 million, another miss in a long run of them. And the unemployment rate has been flattered by people leaving the workforce rather than by people finding jobs. On oil, crude fell about 5.5% Monday after the administration said the outline of a deal covering the Strait of Hormuz had been agreed, and then bid back Tuesday. One caveat: there is load bearing. Tehran denies it is talking to Washington at all, and says its discussions with Oman concern shipping routes only. Trade the barrel, not the headline. Here is the single most revealing number of the day: 5 times, down to 2 times. In February, investors put in roughly $5 of orders for every dollar of hyperscaler bonds on offer. By July, that had fallen to about 2. And the reason this is the tell is that nothing about the artificial intelligence story got worse in those 5 months. The earnings got better. What changed is the price lenders' demand to fund it. Those same companies have issued around $244 billion of bonds through mid-July, against $121 billion across all of last year, and an annual average near 28 billion in the 4 years before that. Cover ratios are the cleanest real-time read on whether capital is enthusiastic or merely willing. This one halved while the equity kept climbing. Sectors in play: software and artificial intelligence, bullish on the print, with Palantir's acceleration real and audited, but the whole complex is now valued on demand durability while its financing costs reprice. Own the earnings, respect the credit tape. Industrials bullish, with Caterpillar's first $20 billion quarter, but understand what you now own. Caterpillar has become an artificial intelligence capital expenditure derivative, and it will trade like one in both directions. Retail and consumer importers are the quiet one today. That tariff refund is a one-time, non-recurring boost to gross margin. It will flatter this quarter's comparison and vanish from the next. Normalize it out before you extrapolate anybody's margin trend. And crypto: Bitcoin is below its 200-week line while equities print records, bearish on the divergence. But historically, that level has been an entry more often than an exit. My honest read is that the credit signal and the crypto signal may be the same signal, arriving in two places. On the radar, the Clarity Act, which decides who regulates crypto in America, was dropped from Monday's Senate floor schedule, and no cloture motion has been filed. It needs 60 votes, and the majority holds roughly 53 seats, and 3 Democratic senators formally came out against it after the ethics provision was cut from the merged draft. Recess begins August 10th. Advanced Micro Devices reports this week, and that is the cleanest read on whether artificial intelligence demand is broadening past a single supplier. Friday brings wage data, which is the one print that could force the hawkish minority's hand, and the refund phases at customs will tell us how fast the remaining $150 billion actually flows, and to whom. 3 new falsifiable calls, dated today. 1. By the third quarter reporting cycle, at least 5 more S&P 500 companies will disclose a tariff refund recognized in cost of sales or as a reduction of inventory. 2. Hyperscaler bond cover ratios will not return to 4 times or better before the end of this year. 3. The Clarity Act will not receive a Senate floor vote before the August 10th recess. If any of those is wrong, we will say so on the day it breaks. So here is the close. The remarkable thing about this refund is not that companies are receiving it. It is that nobody had to hide it. It is in the 10Q, in plain type, in the cost of sales line, correctly accounted for. The clearest transfer of wealth this year is sitting in public filings, and it took a viral post to make anyone go look. The question worth sitting with is this: if the tariff was a tax on consumers when it was collected, what is it when it is refunded to somebody else? We went deep on exactly that in today's Focus episode, and the link is in the description. This has been the Asymmetric Daily Brief. Research and education only, never financial advice. The Asymmetric Signal. One contrarian read a day. Subscribe.